So, welcome everybody to Token System webinar series. We are very happy to have so many of you joining us today at the third webinar session of Token Systems, Economy of Token Systems. My name is Stefania and I'm Birdchain Association Manager. Birdchain is a nonprofit.
Welcome everybody to Token System webinar series. We are very happy to have so many of you joining us today.
Sorry, I have the live streaming on. Sorry for that. We were saying Birdchain is a non-profit member-led association based in Berlin, promoting and connecting the local Berlin blockchain ecosystem. And today's event, the Token System webinar series, Economy of Token System, it's happening also live streaming on YouTube. And we are also recording the episode. And Token System is a series of weekly webinars running through this April to explore more in-depth token-based systems in different tracks. This specific webinar episode will tackle a few economic aspects in token systems, such as use cases of token systems in DeFi and liquidity for tokens and how token economies benefit from DeFi. Then we'll have a last session next Friday about legal engineering on April 30th. For those who are interested, I'll be pasting more info on the chat. So just to run through some housekeeping, to ask a question, please use the Q&A function at the bottom of the screen. This will allow you and your question to be seen by the panelists, and we will answer the question towards the end of the session. We will also have a live Q&A session at 5:50. So now it's my pleasure to introduce the speakers of today, Juan Carlos Escallon, head of Blockchain Academy at Plus One Academy, presenting use cases of token systems in DeFi, high-level overview on the different roles of tokens in DeFi. Welcome.
Thank you very much, Stefania.
And Adrian Krion, founder and CEO at Spillworks, walking us through liquidity for tokens and how token economies benefit from DeFi. So welcome, Adrian, as well. Welcome, you guys.
Thanks for having us.
So I land the word to Juan Carlos, who is the first to present.
Thank you very much. So do you see my screen?
Yes.
Perfect. Okay, thank you very much, Stefania, for the introduction and for the invitation. My name is Juan Escallon. I am head of Blue Swan Blockchain Academy. Blue Swan Academy is an educational platform for DeFi, for crypto, for blockchains, and we offer webinars, workshops, and online courses. If you're interested on learning more about our offering, you can contact me after this presentation. So today we are going to talk about one of my favorite topics and one of the most important topics in the whole crypto industry, DeFi. And in particularly, we're going to analyze different use cases of tokens in the DeFi sector. So a brief overview about what I am going to present. I am going to start explaining what is DeFi and describing the main features of decentralized finance. And then I will go into describe the most important use cases of tokens in the DeFi industry. I'm going to refer to three important aspects. The first one, tokens as money, as monetary assets. The second one, tokens as capital assets, as financial products. And third, tokens as governance tokens, tokens that confer political rights, voting rights. So let us start off with DeFi. And DeFi, ladies and gentlemen, is one of the fastest growing sectors in the whole crypto industry. We see here in the chart the market cap, that is the value of the system. And currently, now we have a value approximately 105 billion. It is worth the whole system. And to give you an idea how fast this is growing, 1 year ago, April 2020, the market capitalization was only 2 billion. So it has grown more than 50x in the last year. Another important metric to show how dynamic the sector is total value locked, TVL. And TVL measures how much value is backing the system. We are going to explain what that means. The TVL now is around 60 billion US dollar, and 1 year ago was under 1 billion. So that is a 60x increase only in 1 year. But what is DeFi? So DeFi stands for decentralized finance. And decentralized finance is an emerging ecosystem of open financial products and services that run on blockchains. What type of products and services? Well, many of them, we know them already. Those are in the left part of the slide, those in the green boxes. We find here things like saving accounts, like borrowing or lending platforms, insurance, payments. We also find more sophisticated things like listing or fundraising assets, derivatives, and so on. The main difference is, although you find these products currently in the traditional finance industry, the biggest difference with DeFi is that you don't have a company or a bank or a centralized organization that provides these services. These services are provided by money protocols, money robots, computer programs, smart contracts that run atop on public blockchains with no intermediaries, automatized. So there's a revolution of previous financial products and services. On the right part, on these orange boxes, you find totally new products and services, financial products and services that were not possible before blockchains. Things like automated market makers, prediction markets, tokenizing real-world assets, decentralized exchanges that run without an order book, stable coins, also known as the crypto dollars. We're going to talk about the crypto dollars. All of these products and services are new, are brand new, and are in experimentation. So the basic, so DeFi, how we define DeFi must comply with specific requirements. The first of all, of course, it has to have a financial use. The second is permissionless, and this is a very important characteristic of certain blockchains, Ethereum inclusive, is that these things are open source. These things are available for everybody, anywhere in the world with an internet connection. You don't have to ask permission for consuming or also for providing services. It's a very democratization of the financial industry. They are pseudonymous, meaning pseudonymous that you don't have to reveal your real identity when you use these services. It is non-custodial. Non-custodialship is a very important characteristic. It is very different from what we know from the finance industry. Non-custodialship means that you always control your assets, you custody your assets. If you think about it a minute, in the traditional finance industry, you always depend on an intermediary, on a custodial. When you have your money in a bank account, you have to trust this institution that takes care of this asset, of this money, of this value. So that in DeFi, you have always control on your funds. The last aspect, a very interesting one, I'm going to allude to it at the end of my presentation, is decentralized governance. All these protocols are governed or are in a way, in their way to decentralize their governance. That means that the crowd defines the future development of the protocol, not a centralized institution. So let's go back to the definition, an emerging ecosystem of open financial and products. So that is the first important aspect to keep in mind, is that they share a ledger. Currently, this ledger is Ethereum. And why Ethereum? Well, Ethereum is the first and largest smart contract blockchain. It will not be the only one, but currently is the largest one, has generated a lot of traction, a lot of networking effects. So today, most of the DeFi activity, is happening on top of Ethereum. Ethereum, as I was explaining previously, is a public and permissionless blockchain, which is an important characteristic, and that is different from other blockchains that are private or that are permissioned. So what can you do in this ledger, in this shared ledger? You can issue new assets, new digital assets. You can create them, you can mint them. So Ethereum is a poly-asset agnostic network. You can create digital asset, whatever you want, with whatever characteristics you want. The second one is settlement. That is an important feature. Settlement means the transfer of one asset, of one digital asset, from one account to another, from one wallet to another. It could mean like the transfer of ownership of an asset. And this happens on top of a blockchain. You don't require a legal system or a country or a company to settle the accounts. That happens everything on chain. And the third characteristic is interoperability. That is a very important and very novel one. Just imagine all of these icons that you see on the slide, those are tokens. Those are tokens that represent different DeFi protocols, different financial products and services. Well, they share this ledger, and you can build new financial products that call the money Legos. You can assemble them and create new products, new novel products and services, and very complex things and very innovative things that don't existed before. So you have like a blank slate here for experimentation and innovation. And emerging ecosystem, why? Because it is a system that is composed by parts that interact with each other. Each part can interact with each other. So as I said, what does this, most of the DeFi protocols have a token. And what can you do? What do they represent? They represent different things. A token can represent an ownership of the network. So keep in mind that we are not talking about like companies or centralized institutions. We're talking about networks, blockchain networks. So in some cases, this token represents part of the ownership of this network. Second, it could represent a financial claim on the cash flows that this project generates. That's something novel. The third thing is governance rights. Some of them can represent voting rights, political rights on the future development of the protocol. And some of them can confer you the right to produce work. And that is something very exciting as well. You can produce work, digital work, to a platform, to a DeFi protocol, and you can get rewarded for it. And one token can represent one of these aspects or all of the four aspects. So let us go more in concrete to the three use cases that I alluded at the beginning of the presentation. First of all, we are going to talk about tokens as money. Then I'm going to talk about tokens as capital asset, and then governance assets. In all of these three examples, I'm going to explain the transition that we are living for analog economy to a digital economy. So let's talk about money. And let's start about the basic question, what is money? And that's a question that economists have posed for centuries. Basically, there's consensus that money fulfills three important roles. The first one is money is a store of value. So you can use money asset for preserving value. Second, money is a medium of exchange. So you can use money as a way for transmitting value. And third is a unit of account, a way of measuring value. So let's start with the first one, store of value assets. What are store of value assets? Assets that cannot be consumed, assets that intrinsically do not generate income. And mankind has used many of them, and especially precious metals and especially gold. Gold is a very good store of value assets. It has very good physical properties, very durable, divisible, and so on. So mankind has used for millennia gold as a store of value, but you can find other assets such as fine art, currencies, real estate, and so on. One common characteristic for store of value assets is that they are scarce. They have to be scarce. If you could produce gold out of thin air, then this gold would lose its value. And the same goes with fine art, currency, or other assets. They have to be scarce. Well, now in the blockchain economy, in the digital economy, we have thousands and thousands of digital assets. And all of them could be suitable for a store of value, because blockchain give us a very important aspect, and it's called the digital scarcity. Digital scarcity was not possible before blockchains. In the first era of the internet, you could copy assets, digital assets, you can copy files. And as I said, if you can copy indefinitely something, then it would lose its value, its property as a store of value asset. Well, now you have this technology, blockchain, and you cannot copy these things, and you cannot alter the code which govern how these things work. So they are suitable for generating digital scarcity. And that for the economy will be very, very relevant. And let me spend a minute in this chart. In the left pyramid, we see the traditional financial system with gold is the store of value that backs the value of the whole financial system. Gold is a terrific store of value asset. It's also trustless, but it has a problem. Gold is heavy. Gold is difficult to move, and gold is capturable. And even so, the central banks capture 90% of the gold reserves. So how this works, the traditional finance world works, is that gold backs the currencies that central banks issue, like legal tenders, like official currencies. And at its turn, central banks back the money that commercial banks issue. As you know, commercial banks in the system, they produce new money that is called fractional reserve banking. And at its turn, the commercial banks back all the financial products, service, payments, credit cards, and so on that support business, and then they support the people. So it goes like that way. The problem is that in each of these steps, in each of these layers, each layer requires permission, each layer has gatekeepers, and each layer has intermediaries. So of the right pyramid, then we see this emerging new financial system with Ether at its core, with Ether as a digital permissionless asset. And up top, you will find different layers that are being built. All of this is being built. And the first layer is Maker Protocol. Maker Protocol is called like a permissionless, like a decentralized bank, a decentralized reserve bank. And on top of it, there are the different layers like borrowing and lending platforms, derivatives, exchanges, and so on. Ether in its role, and I repeat this slide that I showed at the beginning, the metric of total value locked, TVL, shows Ether in its role as the reserve asset for DeFi. Let's get to the second use of money, medium of exchange, currencies. Mankind has also used throughout its history many different currencies, coins, even things like beans, shells, even in restricted markets like in prisons, cigarettes are used as a currency, as a medium of exchange. In the digital world, in the blockchain world, we also have thousands and thousands of tokens that could potentially be used as medium of exchange. The problem is volatility. And if you have seen the markets in the last week, they have been crazy market. We have one day 10% up, 20% down the next day. So that is a bad thing for a medium of exchange. You cannot have a volatile medium of exchange. You want this thing to be stable. So that is why the stable coins were created. And stable coins are tokens that are pegged to another asset and that are reserved by another asset. Yeah, most of these are pegged to the US dollar, and they are called crypto dollars. There are two main classes of these stable coins. You have stable coins that are collateralized by fiat. Fiat is a currency like euro or dollar. And these are like the three main ones. So with these tokens, you can theoretically go to a bank. USDC is Coinbase, and you can go to Coinbase. They have a bank in the traditional world, and you have this IOU, which you can redeem for a physical US dollar. And theoretically, each of these assets are backed by real dollars in a bank. On the right side, we see the emergence of new stable coins, and there are crypto collateralized. They are not collateralized by a real US dollar, but by crypto assets. The most important one is DAI, that is the stablecoin that is product of MakerDAO, and it is collateralized by Ether and by many other crypto assets. The stablecoin market has grown exponentially, like everything in DeFi. The total supply now of stablecoin is $60 billion US, and 1 year ago was $7 billion. So you can calculate the increase. So let us go to the second big use cases, capital assets. What are capital assets in the financial industry? Capital assets have an ongoing source of value. And normally capital assets are valued. There are several techniques, discounted cash flows. You calculate the expected returns and then you can calculate the value of this asset. And the most well-known are equities and bonds. Yeah? And how they work is that you have a company in the real world. This company generates revenue, creates value for the economy. And if you're a share, you have a share, you're a shareholder, you can capture part of this value that the company generates, normally in form from dividends. Well, we have a similar thing emerging in DeFi, and that is very interesting. I will take the example of Aave. Aave is a lending and borrowing platform. And you can imagine it as a sort of like a crypto saving account, right? You can deposit asset, you earn an interest. Now, if you can see for DAI, you have 5.7%. That's not like super extraordinary, but it's much better than what you have in your normal saving account. And you can also borrow assets and take like a crypto loan. So you have this protocol, this borrowing and lending protocol, and it works a bit like a company. Yeah, it has a business. It's like a bank, like a crypto bank, and it generates revenues. And if you have an Aave token, with this Aave token, you can accrue value. You can capture value, part of the value that this protocol generates, and it works like a share. It works a bit like a digital share. And we see a lot of experimentation of many DeFi tokens, and I named only this as an example. Different value capture models or value accrual mechanism of different DeFi tokens. For example, MakerDAO has a second token. It's called the Maker token, and you receive, the way they use it is a bit more complex because the revenues generated by the Maker protocol are being used for buying and burning Maker tokens. So these have a deflationary mechanism where the issuance get reduced each time the protocol generates money. Other platforms like Synthetics, derivatives platform, SushiSwap is at the centralized exchanges. They direct part of the revenue that the traders pay to the holders of this token. So they act a bit like shares. Another example of, and keeping the example of Aave, is the interest generating tokens. So in this example, you deposit DAI in Aave, and you earn, for example, in this example, you earn a 5.7%. And what happens in the background? Aave issues a new token. It's called A token. It's a derivative from DAI. And this A token represents, this A DAI represents your deposit plus interest. So it is designed that if you own this A token, the token is automatically generating interest. It's an interest accruing token. So it is a capital asset. It continuously generates income. And the beauty is like everything in DeFi is interoperable, then you can use this as a collateral for something else, or you can put this token to play in the whole DeFi ecosystem and you can interact with different protocols. So it is basically like a tokenization, a tokenized representation of your savings account. And a lot of projects, I name here only some examples. Aave has its A tokens, Compound has its C tokens, Fulcrum has its I tokens, Keeper its K tokens, and so forth and so on. Then let me go to the last use case, tokens as governance. And let me compare again with the traditional economy. In the traditional finance world, the shares also confer political rights, governing rights. And typically how it works is that one share is one vote. And if you own a share, you can go to the assembly and you can participate and vote for certain decisions. The same thing is happening in DeFi, but in a decentralized fashion. The tokens confer governing rights, and you can vote on the future developments of the protocol. And these tokens, with the tokens, you can go and vote. And the reason behind this is that the ethos of DeFi is radical decentralization. So we are now seeing how all these protocols are doing very different simultaneous experiments on how to decentralize themselves and transition into DAOs, decentralized autonomous organization. And what can you vote for? What type of decisions? There are many, many different models. MakerDAO, for example, you can vote on interest rates. You can vote on changes, technical changes that changes directly the smart contract on the blockchain. Other ones here I name Uniswap, that is the largest decentralized exchange, or Yearn, that is a yield aggregator. You can decide only about the allocation of funds that are in the treasury. And for comparison, traditional assets like Ether or Bitcoin, there are no governance tokens. So you cannot vote. Ether and Bitcoin have off-chain governance. And most of the DeFi protocols have on-chain governance, and there's a huge experimentation going on. So concluding, the three main use cases for DeFi: tokens as money, tokens as financial products, and tokens as governance. Yeah, thank you for your attention, and happy to answer your questions after the presentations.
Thank you so much, Juan, for your insightful presentation. I just want to remind the participants that you can always gather your questions in the Q&A button section. We will address them around 5:50. Thank you. I will hand the word now to Adrian Krion.
Thanks a lot, and a lot of great insights from Juan, and I'll build upon that. So after Juan was basically talking about what kinds of tokens you have when it comes to DeFi. Hang on, I'm trying to share my screen. I'll talk a little bit about what DeFi does for your tokens if you have them, right? So tokens that are outside of, that have been issued outside of DeFi, or are living outside of DeFi. And now the question is, how can your non-DeFi token economies benefit from DeFi? Sounds weird, but we'll get to that in a second. Maybe a few words about myself and Spielworks. I'm based in Berlin, or we're based in Berlin, and we're operating two products. One is OnePlay. This is a crypto gaming reward platform that rewards people with crypto for playing games. And we have Wombat, which is one of the largest gaming wallets. I hope that you can see my screen. Yeah, I think that should work, right? So yeah, let's dive right into it. Juan was talking about DeFi in general and kind of what is in DeFi, and I would like to talk about amms, so the swap models specifically. And in order to just give you a little bit of background, the first question that we need to ask, so how is that all working in the traditional world? So in the traditional world, when we want to trade assets or swap one asset into another, we typically encounter the bid-ask model. So you basically you submit orders, buy and sell, or they're also often called bid and ask, you basically most often you specify a limit price. So how much do you want to pay, or how much do you ask for your asset in the other asset? And then if two orders have matching prices, so if there is one sell order that has a lower price than the highest buy, or the other way around, then these orders match, and then there's a trade, right? And this has worked quite well. The only problem here is that if you want to trade, you always need liquidity. So you need a bunch of orders in the market already. And if you don't have them, you will not be able to trade, right? And so the question is how much liquidity you have in the market. And this liquidity is often measured in kind of order book depth, so-called, or spread. That means basically how much do you have to derive from your from like the reference price in order to get your order executed. And because of that, we have market makers like professional traders who are taking care of providing this kind of liquidity, basically putting up orders in the market so that there's always something to trade against, right? That's how like professional financial markets work. And now in our decentralized DeFi world, it all gets a little bit more fascinating and automated, and because we now have software that runs independently of a central entity on the blockchain, we have a thing called automated market makers. Juan was mentioning a few like Uniswap, and they have been designed to always ensure that there is at least some amount of liquidity for an asset pair that you want to trade. Right, an asset pair, it means that you always trade one asset against another. So you can trade Tesla stock against dollars, or you can trade Tesla stock against euros, right? And so we always have to watch it like that. And what an AMM does is that there's always a buy and a sell of order at the current market price, at least for a certain size of the of an order. And the price of the asset, if you want to buy or sell it in this market, is basically just determined by the size of the so-called liquidity pools on each side of this pair. So if I have, let's say, Tesla versus US dollars, there has to be Tesla shares on one side of the pool and US dollars on the other side of the pool. And then the ratio of these, of the sizes of these pools basically tells you kind of what the current price is. And this basically allows people who want to use an AMM to swap one asset into another. And this swap is like a very simple operation. So you don't need to wait or look out for, is there enough liquidity or so? You can just basically always get it executed. And liquidity is now measured slightly differently. It's measured in kind of the pool size, or if you have an order at hand, if you know, okay, this is the kind of order that you want to submit into this AMM, then you are told what your price impact is, and this is typically called slippage. Let's have an example, because that's very abstract, right? So let's imagine we want to trade US dollars versus euros, and this is obviously a fictional example. So it's not obviously not the right rates. So imagine we have an AMM, and that AMM holds a pool of 2,000 US dollars and 1,000 euros. That means that the ratio is 2 to 1, right? So that effectively means that in this market, 1 euro can be exchanged for 2 US dollars. And now somebody comes in and says, okay, I want to sell 100 euros against dollars. And now the question is, how many dollars do you get for your 100 euros? And how does that change the market, right? So 100 euros put in into the euro pool will increase the amount of euros from 1,000 to 1,100. And now there has to be US dollars that go out from there. And the question is, how many US dollars do we actually take out? And this is determined by now it gets a bit complex. This is determined by a so-called invariant. So you basically multiply the size of the US dollar pool with the size of the euro pool. And so that's a number that's 2 million. And this is the invariant that always have to stay constant. So if one of the numbers changes to a higher number, the other number has to go down. So if you divide 2 million by 1,100, you end up with a number that's almost 1,818. So that means that afterwards, after your trade, the new price for this token pair is €1 is worth $1.65, and it basically means that your swap price is you get 182 US dollars for 100 euros, so that your average swap price was $1.82, $1.82 per euro that you've been getting, right? So that's just how these AMMs work. I know that there's a lot of complexity in there, but just so you get a slight insight into what it all means. Now, the question is, where does liquidity come from? So if we have market makers and like professional traders in the traditional markets who submit orders, and then you've heard of like all kinds of bots and high or low latency trading or high frequency trading and so on. There's a lot of like players in there. In automated market makers, the liquidity can come from anyone. So anyone can provide liquidity. And what it means is that liquidity providers become market makers themselves in a way. And they're basically offering their tokens for swap, right? So both let's say in our example before, if you provide US dollars and euros into the pools, then that means you're always offering US dollars for sale, and you always offer euros for sale. So the adding or the removal of liquidity is always done at the ratio that's basically currently in the pools, right? So if there's a ratio of 2,000 to 1,000, like in our previous example, and you want to provide liquidity, then you would have to provide liquidity into both pools at the same time, both US dollars and euros, at a ratio of 2 to 1. And the only person who doesn't have to do that is the person who provides the first liquidity in a given pool, right? Because this person sets kind of the reference price. This is very interesting. We'll get to that in a second. Why that's interesting. Yeah. So, and the more tokens are in these liquidity pools, the lower the price impact is whenever you perform a swap on it. And that means that, I mean, you have a direct correlation between the size of the pools and kind of the price impact for each order that you put into the market. And the last interesting part here is that typically the providers of liquidity, they are rewarded for providing this liquidity by basically a fee that's being paid by the person who swaps. And this is typically taken away from the target amount. So if I swap my 100 euros into $182, then I will not receive $182, but $182 minus 0.3%, which is typically the swap rate on these AMMs. Now you might wonder, this is a little bit of an excursion, what actually does it mean if you provide liquidity? And this is a very interesting topic as a user. So some of you might have kind of experienced Uniswap or some of the other AMMs, and you might have played around with them. And there's always something that's called impermanent loss, and many people wonder what that means. So like I said earlier, when you provide liquidity into an AMM, that means you're always offering your tokens for sale, right? And you do that at the current market price. So you don't stop offering liquidity just because the price changes. And so you're basically exposed to all price movements and all price risks with that, right? So you're basically just like a traditional market maker who does that as well, right? That means that if you want to hold a token and just kind of you are bullish on the price of that token, then it's typically better to hold that token and not provide liquidity with it if the price goes up, right? So you're better off just holding the token, not providing liquidity for it. This is, like I said, this is what mostly is referred to as impermanent loss, but that's actually pretty weird because impermanent loss is not impermanent; it's actually permanent. So just to understand what the risks are when you provide liquidity, if the price moves after you put in liquidity, you basically, that means that you've sold tokens from one side of your pool, for the other, right? And in order to kind of recover your impermanent loss, you would have to buy back those tokens first, right? And that's like the tokens that you sold. But you would have to do that at the current market price. This is what breaks this entire system. So if you are long, if you're bullish about one token, then you should be very cautious about providing liquidity for this token if you just want to kind of make returns on that token only. So you would also have to watch out like how much trading volume is going on this AMM and this pair, so that you know how many fees you can expect to get back. So just to be clear, we always need to acknowledge that we're fully exposed to price changes and price movements of a token, even if we're providing liquidity. So there is nothing called impermanent loss. There's no guarantee that you'll get it back ever, right? That's just important to know. Anyway, what's cool about AMM? So why am I excited about him? Why is Juan excited about them? Why is everybody going crazy about them? First thing is that you can get your token swap executed with kind of a guarantee, right? So it can't happen that there's no order to match your order. There's always an order because that's what the liquidity providers are doing, right? And that's a very powerful aspect. Then what you can also do is that you can, because of the guaranteed execution, you can also chain swaps. So you can swap an asset A into B and B into C, and you can do that simultaneously. So instead of making multiple swaps, you can just basically make one and end up with a swap of asset A into asset C. So that's great because you don't need market makers for all combinations of assets. You just need kind of one transitional asset. So that can be one of the store of value assets, for instance, that Juan has mentioned. You can basically always swap into this asset and then out of it into another token or another asset. And this is a very powerful example. These AMMs can be very capital efficient based on kind of the amount of liquidity that you have to provide as compared to the slippage that you provide, so the price stability that you get from that. There's a huge debate about capital efficiency of AMMs, and there is a lot of work being done on that. So that's very fascinating. In some other under other circumstances, can be that it's much less capital efficient than traditional markets. But at least what we get is that we get very low spreads and very, very high price stability, especially for low volumes that are being swapped. That's something that's really great. So that also helps a lot of kind of retail investors or everyday users who don't have to worry that they will be played around with by large players. And they're inclusive, so anyone can provide liquidity and make and generate interest from them. And this investment can be very lucrative if you know what you're doing and if you provide liquidity for the right assets. One interesting aspect, because we're talking about token economies and token systems, is how AMMs have enabled kind of a new type of fundraising, like a new generation of token launches, where effectively what you do is you raise or you do a token sale, but this token sale is typically fairly small. You then take or use some of the proceeds from this token sale to put up liquidity for your own token, and thereby effectively providing a price immediately and liquidity for the token immediately. So anyone who invests into that token can actually start trading it very, very quickly, and token projects don't have to pay horrendous listing fees to large exchanges, and that during the ICO craze that was up to a few $1 million dollars that would have to be paid in order to get listed on a major exchange. So just as an example, what you could do is sell your tokens for like in a community sale for $500,000 in ETH at a $1 price, with the expectation that you will use that ETH that you've got to put up a liquidity in an AMM, let's say together with 250,000 of your tokens, which will basically set the reference price of your token to $2. So at least some people will be able to swap their tokens at a price of $2 or around about $2, which is very, very interesting when you're trying to build a token economy and you're looking for liquidity. Last but not least, I just want to kind of quickly talk about what's possible through AMMs. Also as a kind of an example of how this can be applied to everyday uses. So one thing that I'm really excited about is what I call seamless swaps. So effectively, whenever you pay something or service online and you are able to pay that with crypto, you could allow programmatically through AMMs that this amount be paid in any other token that's available on the AMM, right? So instead of paying 0.04 ETH for whatever I was paying here, I think that was something for like $100, I could offer any other asset that I might hold and immediately swap it and pay, swap it into Ethereum and pay in ETH, right? And that's something that's very cool because people in this world will hold all kinds of assets, and they will be able to pay whatever they want with them. And the second thing that I'm really excited about, and that's getting a lot of traction, is that if people provide liquidity, they can be rewarded for doing so with benefits from inside the token economy. So for instance, if you have a game and your in-game currency is a token, then you can incentivize users to put up liquidity in an AMM by granting them some kind of a VIP status or paying them back in tokens or giving them rewards in the game, right? So that's just some kind of advanced use cases that you can apply when you have AMMs. And if you're building your own token economy, these are things where it can get started. I wanted to talk quick. I also wanted to talk quickly about NFTs, but looking at the time, I think we'll skip that. We can cover that in the questions. So that's all by me. Thanks a lot, and I'm happy to answer some questions regarding what we've been talking about.
Thank you so much, Adrian, for your very interesting presentation. And I think if you want to tackle the NFTs quickly, we can see if we have some questions, but I think there's only one question in the chat. But if you guys have questions, it's really time to ask them. So meanwhile, we are waiting for more questions. I can read this that looks actually like a question from T. Knorr on the chat. Is using an AMM for playing around speculation? In traditional markets, you buy currencies because you need them, for example, for businesses.
Juan, is there anything that you want to say on that, or shall I go?
I think AMMs are very powerful instruments. I think one of the most interesting features is that you can generate immediately a secondary market. You can issue a token and you can generate immediately a secondary market. So you can generate liquidity for it. And previously you were explaining, Adrian, so like projects had to go to centralized exchanges. They were like the gatekeepers, and now it is possible. So it's not only speculation; it's about creating markets. So you can create a digital asset, and you can automatically create liquidity for it, and that's what these yield farming programs are subsidizing, are incentivizing, and that is a very powerful feature. That's one that I can think of.
Yeah, and another, or building on top of that, another thing that I can think of, I mean, we're at the very beginning here, right? Uniswap as kind of the first, it's not the first, but let's say the first major AMM that has become like tremendously successful. That's been around since 2018, right? So that's about like not even 3 years, right? So right now, it's a lot of speculation that's going on there, as in kind of like many places in the crypto markets. But the first kind of advanced use case that I was showing is something that I think will be very commonplace in the future, that you will be offered kind of checkout methods with all kinds of currencies that you may have. So you don't actually need to hold a particular currency. You can just swap it on demand, and you don't even know that you've swapped it, right? You just you get offered checkout in your currency, in the currency that you want, right? And yes, right now we mostly see stable coins denominated in US dollars, right? But that's already changing with a lot of the projects, like the Terra project is very successful in kind of issuing a lot of kind of local currency stable coins. And with these kinds of things, you'll obviously be able to pay. Let's say you want to buy an asset or like a digital thing from the USA, and the price is denominated in US dollars. And you only have Korean won or something like that, right? And then you can swap your Korean won stablecoins into US dollar stablecoins immediately and pay whatever you're buying there. And like your exchange rate fee is 0.3%, which is kind of the AMM fee, and that's it, right? You don't have to kind of ask a bank for a kind of a swap or exchange rate. You don't have to pay high fees and so on. It's that's it, right? And you can do that from all over the world without even asking the shop whether they could offer checkout in Korean won, which is, I think that's amazing. So there's still a little way to go here for like widespread applications, but I think that we'll see that within the next 2 or 3 years, for sure.
If I may add something, you mentioned that Uniswap is around since 3 years, and Uniswap is a perfect example of the efficiency gains that we have with this technology. And now Uniswap has reaching the volume levels of a Coinbase. And Coinbase is a centralized exchange with hundreds of employees, now did an IPO. So it is like 10x better. And not only it exists in 3 years, it was like a spin-off. It was an Ethereum grant, 100,000, I think. And one developer, now it has like 5 employees or 10 employees, and it is trading the same volume as a 150 person company that they did an IPO with 100 billion valuation. And then, but Coinbase is at its time 10 times better than traditional banks. So we have like different layers, multiple times efficiency gains, and that is amazing to see.
So yeah, we are starting to have a few questions. So we have one in the Q&A from an anonymous attendee. Tell us a little bit more about fundraising for new projects, creating new tokens on Uniswap, for instance. Is it possible nowadays? I know Binance has a launchpad offer.
Yeah, that's a very good one, because it's always hard to kind of dive too deep into that. So what you can do with AMMs, and Juan was also touching upon that, is you can put up liquidity yourself, and through that you immediately have both a liquidity option for your tokens that you've sold, maybe in a sale, and you also have a price. Right, so you can determine the price yourself. So imagine you're not thinking about kind of a launch pool, launch pad kind of thing where you raise 2 million at once, but you're just thinking about issuing a token for your local community. I don't know, whatever you might think of, right? And what you can do now with Uniswap or any other AMM, right? It doesn't have to be Uniswap. Uniswap is very expensive in terms of gas cost, so it's not as inclusive anymore. But you can create your tokens. Let's say you create 1 billion or 1 million tokens, and then you put up 1,000 of those tokens into a liquidity pool together with 1,000 US dollars, let's say US dollar stablecoins, right? So suddenly your tokens, of which you have 1 million, have a price in the market, right? And this price is $1 because you've put up 1,000 tokens and $1,000, and that means that your token is worth $1 each at the current market price, and your total market cap of your tokens is 1 million, right? So you've created a token that's actually valuable and that has a market cap of something that's significant, right? And now if anybody wants to buy the token because it has some kind of utility, you say, okay, I'm doing a 15-minute Q&A session with myself for one of these tokens, right? And now people have to pay me that token, and if they want this token, they have to buy these tokens on Uniswap, right? So somebody buys one of these tokens at $1 and pays $1, and then they pay that one token to me and get a 15-minute session. I don't think that anybody wants that, but anyway. So now the next person will not have to pay $1, but $1 and a few cents, right? So the price may be going up, and you have the remainder of these tokens, right? So that can also be a fundraising kind of scheme where you then sell off some of these tokens into the liquidity pool if there's kind of demand for these tokens. So this is something that in a similar way is happening right now. Like I was explaining, there's a lot of projects, for instance, specifically on PokeStarter, which is kind of a pretty new fundraising platform for token projects. And many of the projects raising or doing community sales there, they basically do it to just take the proceeds, the Ethereum, the ETH that they get from there, and put that up on Uniswap so that you have immediate liquidity. You don't have to ask Binance. It's very, very hard to get onto Binance Launchpad. It's almost impossible. I mean, there's like one project every month out of thousands and thousands that are applying there. And with Uniswap, you can just do it. You don't have to ask anybody. It's permissionless. That's great.
So thank you, Adrian, for your answer. And we ran out of time for questions. So thank you, Juan and Adrian, for your insightful presentations, very clear and interesting. And thank you to all the participants who have joined and engaged. Thank you for attending, and I see you to the next and last episode about legal engineering next Friday.
Thanks a lot.
Thank you.
Have
a nice weekend, everyone.